Welcome to this Click Explains Finance video. This week, fairly obvious topical topic, the coronavirus. I want to look at how it could, not saying will, checkmate central banks. In other words, central banks have got a difficult act at the moment. Yes, Federal Reserve already cutting rates, other banks following suit, but it's not as easy as it first looks. There is a catch and there's a scenario that they need to keep an eye on. So, background is what? Well, as everybody knows, coronavirus has spread quickly and has put central banks under pressure to do something to stabilise stock markets in particular, asset prices in general. The Federal Reserve has already cut rates, that's happened, and the impact this time is less certain and may even prove incorrect or ineffectual. So what we're saying here is that normally traditional central bank reaction, and we'll see more of this, is cut rates, maybe add in some quantitative easing, print money, get people basically out of safe haven, low risk assets into riskier ones. Get things moving. Will it work this time? Maybe, maybe not. And if it doesn't, it might actually be counterproductive. Now, why is coronavirus such a worry? This is probably telling you stuff you already know, but let's recap on this one. Unlike seasonal flu, this virus was not predicted, so no vaccines have been developed. It'll take some time, I understand, to do so. Data on the impact and extent is necessarily patchy. It takes a while to basically detect. It's very easy to spread, it would seem, and it's untreatable with any certainty. So basically that's why the UK government's following a kind of containment strategy, if you like, trying to limit the damage without really knowing how to actually stop it. The hope being it'll sort of burn itself out. And as I speak, there's some evidence that may be happening in China, where the whole thing started. Now, so what so far? So we know it's bad, we know there's no immediate cure, we know that the Chinese got it under control. So what is the impact? Well, there's a demand effect. So what do I mean by that? That is the more obvious impact, if you like, the central banks are trying to deal with. So the spreading virus is curbing demand in many sectors. People are cancelling flights. Leisure facilities are proving that people are not spending money like they used to. Goods and services in some sectors are taking a hammering. In others, we're seeing increased demand. That is essentially deflationary. If you get a demand hit, some sectors will benefit, if you want to see it that way, some won't. But overall, that is normally seen as deflationary. Less demand for goods and services, people less confident, will tend to mean that prices drop rather than increase as firms try to offload stock that isn't moving as quickly as it used to. Interest rate cuts and quantitative easing may have an impact there. So if this is entirely demand-led, if we're looking at a deflationary spiral, which a lot of people think we are, then you may be able to head that off in the past to a degree, at least cushion the impact with drops in interest rates, plus money printing, stimulus measures and so on. And people are speculating just how far can rates go? Can they go into negative territory? How much money can be printed? We don't really know the answer to that question. An awful lot, it would seem. So that may, and I stress the word may, be enough to see off the worst of the economic stock market crunch, if you like. But what if there's a supply effect as well? Now, this is slightly unknown territory, which is where the nerves start to creep in, if you like. I've not seen a supply side crunch, and I'm over 50 in my lifetime globally, and I hope I won't live to see one now. But what does it actually mean? The supply effect is this. As factories close, and as people are not able to move, go to work as easily and so on, essentially fewer goods and services get produced. There's less stuff around. Now you might think, well, what's the problem? Because if demand is falling, well that means there's less stuff but then less people want it, if you like, so that kind of balances out. And that'll be, broadly speaking, correct. But if you get a supply crunch out of kilter with a step down in demand, if you like, then you could have a problem. You could even have an inflationary problem. Now, not everyone believes this argument, but if there's less goods and services available, people still want them, or you get a sudden spike in demand as people think actually things are not as bad as we thought, you could get a bit of a crunch. And now perhaps you can see the danger of being a central bank, just want to flag it. If you are creating demand as supply starts to peter out, if you like, you may have a problem. So interest rate cuts and quantitative easing would be pointless in that scenario, a supply crunch, and even a little bit risky because you may stimulate inflation. Now, this is not a widely held view, but it's a possibility. We are in slightly unknown territory at the moment. So reputational risk is what? Well, essentially this. People have leaned on central banks for some time. There's been an assumption over the last 10 years that the central bank put will kick in. In other words, the moment markets and asset prices show signs of wobbling, the moment consumers and businesses show signs of being nervous, central banks will hop in with interest rate cuts and or quantitative easing. They'll ride to the rescue. And if you are a central bank fan, if you like, that would seem to be the pattern we've seen since the financial crisis going back 10 years or so. But the problem is, if we have a supply shock, if that's what we're dealing with at any point, and central banks are dropping rates, then the speed at which they'd have to raise rates later to combat inflation would almost give you a kind of double dip scenario. Just as people are starting to get back in the saddle, if you like, you'd have central banks sort of having no choice almost, but to sort of squash that increase in confidence and increase in demand. Not saying this is going to happen, but it's a scenario that you should have at least in the back of your mind. So conclusions from all of this. For policymakers, beset by unknowns, no reaction, none reaction to present risks. So basically, the FT have highlighted the fact that it's difficult to be right in this scenario. Central banks are taking their best guess as we speak as to what the right course of action is. Coronavirus is testing the strength of supply chains and the financial system, both together. And we've not seen that for some time. Hopefully, central banks will deal with that, headed off at the pass, but it is a double whammy potentially that investors should keep half an eye on. And basically, there is a risk that a Trump-led Federal Reserve response, if you like, may overcook it. So the Federal Reserve is meant to be, broadly speaking, politically independent. If banks like that come under pressure to cut rates, or just cut rates to head off what they see as a rapidly developing emergency, then Ronald Reagan's advice to don't do something, just stand there, may be advice they come to wish they'd heeded. So there we have it. Unknown effect of coronavirus in terms of its total extent. Central banks doing their best to read the mood, combat deflation as they see it, but there is what I'd call that tail risk that this time around we could get a supply shock somewhere down the line, and central banks need to be ready, I guess, for what that might mean in terms of a policy response. Tim Bennett at killick.com with any questions, and if you want to watch videos related to this one, there is our regular weekly market update video, and also you've got killick.com/learn.